we're going over Silicon Valley real estate market June 15th. Here's some of the key slides we're going over. We have distributions, we have heat maps, we have the summary of the heat maps, and we also have some of the key components that we'll start off with. So here's some of the key components. Inventory, you're starting off on the left. That's where we were 14 weeks ago. That's basically a quarter. And this is where we are now. So you can, and the fine red, gray, and blue lines are where the market typically is. You would expect inventory to be on the gray line. It's a little bit below, which means a lack of inventory, which is a hotter marketplace. And so it's a hotter marketplace. There's less inventory, so there's a little bit more competition, but it's not dramatic. It's fairly close to typical. If you, and this is your percentage, you're basically 10% less inventory than you should be. A quarter ago, we were 25% less inventory than we should. But let's look at offers now, the same concept, but here the red is on the top because a lot of offers is a hot marketplace. A red is favoring the seller or hot marketplace. Blue is favoring the buyer or a cold marketplace. A quarter ago, we were at 67% or losing a third of our offers. Now we're only losing 20% of our offers. So it's still definitely a cool marketplace, but better than it was. Moving on to DUI. A quarter ago, we were at 33 days. Now we're at 36, basically unchanged. And that is actually cooler than we typically are at this time of the year. So typically at this, even though I consider 35 days to be a fast-paced marketplace, basically anything under 6 weeks, which is 42 days, I consider to be fast-paced in a seller's marketplace. But typically at this time of the year, using the last 10 years as my definition of the typical, we are normally faster than 35 days. So even though today, I would say that 35 days is a fast marketplace, it's actually slower than it typically is for this time of the year. Moving down to time to sell, which I measure by the 75th percentile. So 75% of the sellers are selling in less than this, and a quarter ago, that was at 15 days. That's the purple line, which is actually fairly close to a hot marketplace. We come a quarter later now, which is present day, and the purple line is 14 still. So keep in mind that the number is for the purple line, the data line, and the typical lines don't have data. But now we're at 82%. So even though the time on the market is a full day faster, the market is normally faster at this time. So it's 18% slower than it typically is. We're back here when we were only 1 day, it was a third slower than it typically is. That just gives you an idea of how quickly the market typically accelerates in the time frame that we were just through. Moving down to ask price reductions. This is the seller that's on the marketplace. They're not selling. They're deciding to reduce their price. Typically, you're up here at only 0.4% price reduction is where we were a quarter ago. And now we're actually taking bigger price reductions, but we're relatively in the same place. We haven't crossed over the gray. In both cases, we're between the gray and the blue. The biggest thing is the range between the blue and the gray is tighter over here. So this tighter distance is probably the same percentage as this distance. Sellers are taking relatively the same amount of price reductions now, which is, even though it's a greater dollar amount, and this is 0.6%. So sellers are reducing on average just over 0.5%. That is not what's happening. That's the average, but what's happening is 15% of the sellers are reducing their price 10% to give you that 0.6, that kind of thing. So a small percentage of the sellers are reducing their price significantly, but on average, which is what we're looking at here, it's only 0.6% price reduction. And that's 11% more negative, which means 11% more price reductions than you expect. Where over here, it was almost double the price reductions you'd expect. A quarter ago, price reductions are typically about 0.25%, and now they're approaching 0.5%, or even more accurately, they were 0.2% a quarter ago, and now they're 0.4%. And then overbidding, you can see that it was 7% overbid. So instead of coming in at asking price, people were coming in at 107% of the ask price. And now they're coming in at 9.4%. So basically that'd be 109.4, 109.5% of the seller's ask price. So you're above the gray line, so the overbidding is more aggressive than it typically is. So that's sort of a quick summary of the key indicators. And again, this is Silicon Valley data, single family homes. Silicon Valley is defined as all of Santa Clara County, all of Alameda County, and all of San Mateo County. Yes, people have different definitions of what the valley is. So what we're looking at now is the inventory. It's 90% of where we normally are. And you can see it's been climbing fairly significantly. About a quarter ago, we were down here at 70%. So we gained 20% of the inventory. Moving on to offers. Offers at the same time have gone from 70%, about 68%, up to 80%. So they're also climbing, but there's now a bigger difference between the inventory and the offers. So again, in my opinion, that's very strong evidence that we were not and are not now in a marketplace that is being constrained by lack of inventory. Yes, there is a lack of inventory, but that's not why there's a lack of offers. In order to be in a inventory restrained offer situation, the numbers would have to be reversed basically. Inventory would have to be like 70% and offers would have to be about 80% of normal. And that would give you a faster than normal marketplace. And at some point, you would, in theory, have a inventory restrained transaction level, but we're not there now because you actually have fewer offers being accepted than you have inventory relative to normal. So you have a slower market. And that's shown in the gray line, days unsold inventory. You're basically almost at 113% of normal. Days of unsold inventory, the lower the number, the faster it is. So if you were down below 100%, which we have been, and this would be another argument, you clearly have spent a fair amount of time below the 100% line, and now you're at 113%. And in fact, we haven't spent much time above 113%. When we've been at above 113%, the market's been really slow. You basically had the slowdown before the pandemic. The slowdown for the pandemic's this little V here, upside down V real quick. But in 2018, we had a real unusual year where we basically had double appreciation, which slowed the market down, and then it came back, and then we had the pandemic, and then we had the 2002 meltdown. Those are the only times in the last 10 years where we've really had a slower than typical marketplace. So Silicon Valley has been on fire for a long period of time. Here's looking at the distribution of days on marketplace. You're looking at every transaction for the past 5 weeks and how long did it take to sell. The purple dash dotted line down here is where we are today. Just below that vertically is a blue dotted dashed line. That's where we were a year ago. So it's actually taking longer, which would be the vertical separation, and it's not much. But if you came up here to the 75th percentile, you're basically somewhere right here, and it's about 2 days longer today to market your property. Now, if you come down to the 50 percentile, it's down to probably about a half a day longer, and you come down here to the 25th percent, and it's probably also a half day longer. But it allows you to see the actual distribution, and we'll step through, and you'll see the bolder line right here. Now you're slowing down last fall, and now you had this spring acceleration coming up right about there is the fastest the market was. And you can see now we've slowed down for about 6 weeks. And the last week and this week were somewhat significant slowdowns. So it's clear sellers are taking longer to sell their properties, which means the market is slowing down. Now let's look at what the sellers are doing on their ask price reduction. It's the same concept. The blue dashed dotted line over here is the worst year. The purple is where we are now, and the blue is where we were a year ago. So again, the market is now cooler with sellers taking larger price reductions this year than they did last year. And we'll step through and see the same concept. You can see you were bouncing around. There's the slowdown. Now you're going to start getting the run up. There's the run up and coming up pretty soon. Right there, 8 weeks ago was sort of the peak of the marketplace. So for the last 8 weeks, sellers have been taking larger and larger. And 3 weeks ago, the price reductions really increased. So again, another strong indication that the market has turned. And I'm not talking about the market crashing, don't get me wrong. I'm just talking about the normal seasonal cycles we've gone. And I think the pattern's going to continue. Now we have the overbidding, and now we're back to the same pattern that we've been following. The purple dashed dotted line is the current year. The blue dotted dashed line is a year ago. This year, overbidding is higher than it was a year ago. All the other indicators were lower, but overbidding's higher. How can you explain that? Basically, a year ago, we were just coming out of the 2002 meltdown. Every time we go through a meltdown or a slowdown or a price drop, buyers get way more conservative on the magnitude of their overbidding. A year ago, they were weighed down by what they just went through in 2022. This year, they're seeing that the market's recovered, and that's a long distance in the back mirror. So they're more liberal in their overbidding. And that's why the overbidding this year is greater than it was last year. We're stepping through, and you can see 10 months ago, you were basically at the summer plateau. Now you're going down for the fall, end of the year slowdown, it's spring's acceleration, and you're coming up now. And we're about right there is probably the peak. There's close to the peak. So the peak was probably 5 weeks ago, maybe 4 weeks ago, but we're clearly down. You can clearly see the purple line is below this. Again, another indicator. And even if that was 3 weeks ago, if the typical escrow is 4, 5, 6 weeks ago, that puts you back 8 weeks ago. So everything is consistent with these leading indicators of when the market changed, and that was 8 weeks ago. Now, that's one of the advantages of listening to these videos, is you're getting an idea what the market's actually doing long before the people's perceptions change. Because I would say most people have not acknowledged that the market has shifted. But what we've been talking about here is the Silicon Valley real estate market for June 15th. We're also going to cover the Greater Bay Area. This link is my YouTube archive. I also have a green shorter root URL. You add in 2024 to get the presentation, not Saturday morning at 9 live. The handout is normally up. You add in H 2024-06-15. I would appreciate you either liking or subscribing or both if you don't already, and like every time you watch the video. It helps get the word out. Thanks. Moving on now to looking at Silicon Valley, the individual components. Here is your inventory. The purple line is always the data line. The red line is where we'd be in a hot marketplace. The gray line is where you'd expect it to be based on the median for the past 10 years. And the blue is the coolest you'd expect it to be. Again, you can see that we've gone away from the red. You know, a quarter ago, at the beginning of this quarter, beginning of second quarter, April 1st, 2024, you were almost at a hot marketplace at the red line, which would be the least inventory you'd expect. Now you're rapidly approaching a normal marketplace. Yes, you're still vertically down, but you're still going up. So what would you expect it to do? You'd expect inventory to continue to grow for about another month to right about here, and then you'd expect inventory to roll off, and it really starts dropping basically right around the beginning of third quarter, which I guess is actually the end of September, beginning of October. And then it drops off for the end of the year. So if you're looking for a needle in a haystack in your real estate hunts, now's the time to be buying, because you have the downward pressure. You don't have the price pressure, but you have the most inventory. If you make it all the way to October, you're going to start having less and less choice. Yes, prices may be lower and there might be less competition, but if you're having a challenging time finding your property, you want to try to get it when there's a lot of options for you. But it only does take one property. Here is that inventory. Here, what we've done is we've taken that gray line in the previous chart, pulled it out straight, and we compared it. So we're down here, and here's 80%. So we have about 90% of the inventory that you would expect to have for this time of the year. Anything around there is a hot marketplace with less inventory. Now we're looking at offers, the same concept. But now you look at this, you were basically following the blue trend up, which is a cool marketplace on the number of offers, and you might have been pulling up, but look at this downturn. Now you're coming into a downturn here for a cool marketplace, and you have a downturn here for a typical marketplace. So it's not surprising that the number of offers has gone down. In fact, one of my longstanding comments is the peak of the marketplace, when you have the most offers, and it worked out for this year as well, as the 5 weeks before Memorial Day. You take the Friday before Memorial Day and go back 5 weeks. That's the period of when you have the most offers. And you can see basically in a straight line up here, it really happens. Now, with Memorial Day, that's one of those holidays that moves 7 days. So that's why these don't look like they're in a perfect alignment, is they move back and forth, and it depends on whether the market was slow in a late year or in the market was hot in an early year can give you a shift of a week. But basically you can see that all these downturns occurred at roughly the same time, and it's basically Memorial Day. Here's offers compared to normal. So you can see that at the beginning of second quarter, we were only doing 70% of our offers that we normally do. And now you can see that we're at 80%, but we're nowhere near 100%. And you can see after the pandemic, we were selling quite a few more homes. You can see that typically the number of offers is a pretty regulated statistic. Nothing causing it to be, but buyers buy it at the typical rate fairly similarly. In other words, there's not much leeway, basically plus or minus 10%. You can see the huge slowdown for the pandemic, and then this is basically the bubble after the pandemic, and this is the now infamous 2022 slowdown. Look how steep and vertical that graph is and how dramatic it is. You went from selling 116% of the normal number of offers down to only selling 75%, and you did it in about a month and a half, which is pretty incredible. Here's the days on sold inventory. Here you're above the gray line, which on days on sold inventory, I said before, you want a fast marketplace is a low number, a slow marketplace is a high number. So because you're above it, even though you're only at 36 days, you're a slower marketplace than you typically are. And you can see that the market slows down until basically Labor Day. And then even though there's less offers, there's also less inventory. So the market actually tends to accelerate a little bit until you get very close to the end of the year holidays, and then it slows back down again. Here's the days on sold inventory versus typical. You can see down here, you would have been in a hot marketplace like we were in first quarter, but basically second quarter has been in a slow marketplace, and that helps turn the prices around, but it's slower than it typically is. And that's, something to keep an eye on. Here's your marketing time, still very fast. And part of the reason it's very fast is we've just gone through a very limited inventory. We've gone through a hot period of time. So there's not any of those sellers that have been on the market for a year to pull up the 75th percentile. In fact, you can see the stair stepping here, and that's one reason why I'd actually like to look at a higher percentage. And I did that offline, and I'm going to stick with 75%, even though you have the stair stepping, which is not the best situation. You want a graph that moves smoothly at all times, and the reason it does that is homes sell a whole number of days. We don't have fractions days of selling. If we reported the hour of the sale, which could be done, then you could have fractions of days, but we don't. And so you have that step function when the data gets low. But again, also just look back in time, you can see the only time the market's anywhere close to this 14 days is right at this time of the year, and it's only for about half the year. So we are clearly in a fast-paced marketplace. Here's pulling out that same gray line straight. And the reason I'm using shade is I didn't want people to think that the lines were always the same percentage. They're not. So that's just indicating a hot marketplace down here when the DUI is typical, faster than typical. Up here is your cool marketplace. And you can see this metric is more widespread. It's more balanced, and it goes further on each side of it, which is a nice metric for understanding what the market's doing. Now we're looking at sale price reductions from the seller. You can see the gray line, and I changed this because it helps me, so maybe I'll need to go over it a little bit. Here's 100%, which would be sellers taking no price reductions. When you go above that, sellers are actually increasing their price. So right early in 2022, sellers were actually raising their ask price after they listed their property. And you can see it also happened back in 2018. But it's also interesting that this is one of the first indicators to change, because here's your beginning of second quarter in 2022, which is April 1st. And I don't think anybody would say that the market changed on April the 1st of 2022. I think most people would say it was in May. And here, this is changing right around Valentine's Day of 2022. So to me, this is a very leading indicator that's interesting. And again, if we come here to more or less present day, look, it turned back here right at the beginning of second quarter. That's when all the market changes. Yes, it changes across, but I'm also going to argue that you got closer to the blue line than you did the gray line. It's hard to see on this graph, which is why I do this. And here you can see that here's your 100% up here. And so it actually got interesting. It's saying it's got closer to the gray line. So the vertical separation here, I guess I was getting trapped by the horizontal. It's the vertical separation that you're going up. It's pretty severe, got pretty small here. And through here, I guess it is pretty severe. And here it's getting to be less. What it's basically saying is their price reductions that they're taking are basically larger than they typically are. Well, this would be no price reduction. Typical is down here about 0.5%. And right now they're taking a little over 1% price reduction. They're taking about 1.1% price reduction, which is greater than 0.25%. Here's the frequency. Now, the frequency of the price reductions is exactly normal. So how can you have the normal frequency of price reductions, but yet an average that's greater? Simply those that are taking their price reductions are taking larger price reductions on a percentage basis. This isn't a thing where the magnitude of the price reductions is larger because the prices of homes. This is done on a percentage. So the frequency, the commonality of price reductions is exactly where you'd expect it to be. And that's basically somewhere right around 11, 12, call it 12.5%. So 1/8 of the sellers are taking price reductions, but that means 7 out of 8 sellers take no price reductions whatsoever. Here's the frequency of that price reduction versus typical. So it's a little bit higher than normal. It's basically maybe 6% more frequent. So even though it's appear to be right on that line, it's a little bit more frequent, which would help to explain why the average is greater. Here's now going over to the overbidding. You can see the maximum overbidding happened back here at 8%, and that was basically 1, 2, 3, I guess about 4, maybe 5 weeks ago was the maximum overbidding, and that's just about when the peak of the marketplace is. And you start looking at this little step down and then level. Well, you got the same step down and level, and you have the same step down and level. You don't have it on the slowest marketplace. You just have a step down. So it's amazing on how predictable the cycle is, even though the magnitude of the cycle is not there. In other words, you're here now. Where do you expect to be next week? Well, because your hot marketplace went down and your cool marketplace is flat, I would expect this number to come down. Now, you might argue it should be flat because it's typical, but you're hotter than you typically are. So it's going to be a blend between these two. And that can give you an idea of where to anticipate the market is going to be next week. So I expect it to be lower, not as much lower as it is up here, but still a little bit lower. Here, you're right now at comparing the typical down here on the gray line. So you're hotter, you're 2% more overbidding right now. So if we have 7.5% overbidding now, the typical overbidding is 5.5%, and 2% less, 2% more overbidding is actually fairly significant when you're talking about median sale price of somewhere around $2 million. That's something around $40,000 more in the seller's pocket. Here's the frequency of overbidding. And again, you can see the frequency is more common than it typically is. It's typically down here at about 73%. It's currently about 77%. And the hottest marketplace you've had is about 84%. Again, not huge. And again, you can expect to see next week to be lower because all 3 of the trend lines are lower. Now, it could possibly go up, but that would be very unlikely to be breaking the trends, which is why I spend so much time plotting the trends. Here's the typical. You can see you're somewhere around 107, 106%, 6% more frequent than it typically is. Here's your long-term appreciation. The straight horizontal line is sort of just your rate of appreciation. This is on log paper, so appreciation would be a straight line. The purple is the actual data. And here it's starting to become very apparent that the sale price has been level essentially for quite a while now, almost the whole quarter. When it started leveling off, it was hard to sort of tell. And then you had this one perturbation of 1 or 2 weeks right here, and now you're back down again. Again, it's sort of saying the trap, not the trap, but the pattern's there. And you can see the pattern happens every year, happens at a slightly different time. but we're clearly rolling over. Here's estimated payments. Interest rates went down a little bit, only a couple hundredths of a percent. But again, and one of the main takeaways I'd like to point out is even though prices are up significantly and interest rates have doubled, payments have only gone from somewhere around, let's call it $7,000 to $13,500. So even though interest rates have doubled or more than doubled, and house prices have gone up, which should give you a monthly payment higher, it isn't. And that's because some of your payment stays fixed, like your property tax and your insurance, and your principal amount isn't even linear because the principal amount goes down as the interest rates go up. So you pay less principal, and that keeps the payment more going up less than the interest rate. Or, if interest rates doubled from, say, well, they more than doubled. They went from 3% or even lower than that, 2 3/4, up to 7%. So it's almost a tripling of the interest rates. Plus, prices have gone up, but payments haven't even doubled. So people say interest rates have a huge impact on house purchases, and I think it actually has less than people think because of those factors. Here's my table, and to me, again, the big takeaway is we're in the 9th lowest year. That's pretty significant. The only year that was lower wasn't the pandemic right now, but was 2023. So just last year, coming out of 2022, we had fewer transactions. But and you're talking about 15% fewer, so it's pretty significant. But we're still the 9th slowest year out of the last 10, and we're the 24th slowest year out of the last 25. So even though we're better than 2023, the lack of transactions. Here we're now comparing the individual counties. You have Santa Clara County in the blue, San Mateo County being the small one in the orange, and Alameda County being the gray one. You can see that Alameda County is getting more inventory relative to Santa Clara. And if you look historically, you can see they're roughly the same magnitudes. Yes, in 2017 and 18, Santa Clara County had a lot less inventory than Alameda. Here's offers accepted, and here's a reversal. So even though Santa Clara County had less inventory, it has more offers than Alameda County. So Alameda County is going to be a slower pace market than Santa Clara because Santa Clara had less inventory and more offers. And now Alameda County had more inventory and fewer offers. So it's clearly a slower marketplace. And San Mateo County is sort of more normal, but less because it's a smaller, and it is still down from where it typically is, as you can see from the historical levels. Here's looking at days on sold inventory. Santa Clara County is the fastest, and Alameda County is the slowest. That's exactly what you would have almost predicted from the previous two slides. And San Mateo County is sort of in between the two. But even Alameda County at 44 days is still a fairly quick pace marketplace. Here's marketing time. Santa Clara County is the fastest. Here, San Mateo County is the slowest, but again, San Mateo County and Alameda County are fairly close. And that's sort of the pattern here is Santa Clara is the fastest and Alameda and San Mateo are slower and similar. Having just said that, now when you get to seller price reductions, San Mateo County is really leading the pack with almost double the price reductions at a little over a full percent. That looks like it's 99.1. So that's a 1.1% price reduction on an average, where Santa Clara is only taking 0.5% and Alameda County is taking 0.6%. So San Mateo County sellers are having to take bigger price reductions to get their properties sold. Frequency of price reductions, San Mateo County has the most price reductions at 15. So we were talking about 1/8%. Here it's higher. We were talking about 12%. It's not a big change, but these are both, Alameda and Santa Clara are both right around 12%, and San Mateo County is at 15%. It's only 3 percentage points, but it's 20% on a percentage basis. So it all depends on how you look at the data. Here's your magnitude of overbidding. Santa Clara County now is actually in second place. So even though Alameda County is a slower county, it's got the most overbidding at 10.5% overbid. Santa Clara is at 8% along with San Mateo. So even though San Mateo is doing bigger price reductions, when it comes to those offers, the overbidding is the same as it is in Santa Clara County. Now, granted, Santa Clara County was higher than San Mateo, and Santa Clara has been coming down the last several weeks, where San Mateo County has been climbing. Here's the overbid frequency. Least frequent is San Mateo at 72%. Santa Clara and at 75 and Alameda at 79. So again, that's a little strange with Alameda having the most frequent overbidding when it's slower than Santa Clara County. Here's your long-term appreciation. Santa Clara County's had the highest appreciation rate. San Mateo County is actually in second now, and Alameda County's had the least amount of appreciation at only 85% appreciation. But 85% versus 210%, both of them are pretty good, especially when you consider leveraging. Here you can start seeing prices leveled off in Alameda County. They've leveled off in Santa Clara County. They've rolled over in San Mateo County. So now prices for the year have probably peaked and are now again in San Mateo County, again below their peak. Last week they were equal to their previous peak. Now again, because of the decrease, they're below. Santa Clara County is just barely above and Alameda County is below. Here's the same information on regular paper for those that prefer. Here's your estimated payments down because of the recent decrease in interest rate and in decrease in house prices. Here's the actual numbers. You can pick the individual county you're interested in and the metric and look at the actual raw numbers. Here's my heat map. Here, what you're looking at is the 20 different micro market areas in Silicon Valley. Red means you're below 100%. No, white is roughly either side of 100%, 12% on either side. And blue is more inventory or above 100% of the inventory you'd expect. Here's looking at offers, much more blue here. Clearly a lack of offers compared to a lack of inventory. Here's your DUI, slow in Alameda County, slow in San Mateo County, Santa Clara County, basically normal to a little bit on the hot side. Here's your days of unsold inventory, very hot marketplace. And basically, when you look at anything under 42 days, yes, there's some cool areas in San Mateo County. 75th percentile marketplace on here. It's pretty respectable to sell your property in 3 weeks or less. Ask price adjustments. This is the sellers reducing their price. In the coast, it's almost a 4% price reduction. In East San Jose, it's up 0.3%. In Cupertino and Sunnyvale, it's down 0.1%. You can see the different variations. Coloring on is probably accurate on this map. Now we're looking at the overbid magnitude. This is how much over the asking price the buyers are coming in based on the amount of competition they sense in the industry. Every area here is above 2% from what I'm seeing. That means in the worst area, which I think is South County of Santa Clara County, buyers are going 2% over the seller's asking price, 2.2 in Atherton, expensive areas in San Mateo County. And then from there, you go all the way up to Berkeley and Alameda with 22.1%. So more than 1/5 higher than the seller's asking price is what is happening on average. Clearly a hot marketplace. But again, remember, this data is lagging behind by the length of escrows, typically 4 to 6 weeks. This is the frequency of overbidding. So how common is overbidding? And here you can see almost every area except for the expensive areas in San Mateo County are above 50%. Basically, if you look at South County at 58%, all the way up to 93.8, so 94% in Cupertino, Sunnyvale. So only 6 out of 100 sellers are not getting over their ask price in Cupertino and Sunnyvale. This is the long-term appreciation as my base year. I'm using the last 9 months of 2015. The red colors are the higher appreciation areas. You can see East San Jose is up there at 103% appreciation. So you've more than doubled your money. And then in a lot of the areas in San Mateo County and even the expensive areas in Santa Clara County, Los Altos, Palo Alto, you're much closer to 50% appreciation. So not bad for a 10-year period of time, but clearly you can see the more affordable, the further commute areas are the areas that have the most appreciation. And that's most likely because the areas that have had the recent appreciation almost always are going to have the highest appreciation because of compounding. And because of COVID, workers are willing to drive further to work because they don't have to go in and they have more flexible work schedules. Here's the sold price. So affordability is in the areas with the highest rate of appreciation. The bluer the color, the more affordable it is. The redder the color, the more expensive the area is. You can see that the peninsula is the historical expensive areas, you can actually see that San Mateo and Redwood City is a slightly paler pink than Cupertino, Sunnyvale, Mountain View area. So you can now actually get more house for your money in San Mateo County than you can in Santa Clara. And I have worked with buyers buying in San Mateo County because they don't like what they see in Santa Clara County. Here's a recap of all the different areas. The white color up here, or the lack of highlight, is basically saying you really can't tell what's going on. These yellow ones are your leading indicators. They're the ones that are telling you where the market's going to be going. The dark orange are the lagging indicators because you need sold prices. Clearly, the lagging indicators are redder overall than the current leading indicators. That indicates indicative of a slowing down marketplace. Then your appreciation, and instead of just following the median price as most folks do, I look at the cheapest 10% as well as the most expensive 90% home. So you get a price range, you got a sandwich. And then I also add in the payment. It assumes an 80% loan at the national average, 30-year fixed, and reasonable estimates of property tax and insurance. Now we're leaving Silicon Valley and we're going to talk about the Greater Bay Area. That does include Silicon Valley that we've just been discussing, but it also adds in San Francisco and Marin as the cities region. Then you have the North Bay region, the Central Valley, and the Central Coast regions. So a total of 5 regions looking at 13 counties. Here's starting off with the actual numbers. You can pick whatever metric it is you think is most valuable for you and look at the actual raw numbers. And here are the slides. You can see everybody's inventory is down. Santa Clara County is probably coming up the most closest to the typical. And Central Valley is the one that's probably got the least compared to where it normally is. Here's the number of offers. You can see offers are still climbing except for in Silicon Valley. Silicon Valley is clearly peaked in reverse directions. You know, it's nothing to be alarming about. It's a cycle that happens every year. It happens as early as beginning of second quarter, and it's as late as the beginning of third quarter. So we're in the second quarter, which is typically where Silicon Valley prices turn around. I would expect prices or the number of offers to turn around in the other areas fairly soon for the most part. You know, if you come down to Central Coast, you can see it is one of the last ones to turn, and it turns somewhere typically about halfway through third quarter. So I'd expect it to go up. That shows you that each micro market area and each region has its own different nuances. Here's your days of unsold inventory. Silicon Valley is the fastest area. Central Coast is the slowest. The other 3 regions are pretty close together at a reasonable clip, somewhere between 45 and 50 days of unsold inventory. This is the long typical seller. Again, Silicon Valley is the fastest sitting there at 14 days. The slowest is actually the North Bay, which is a little bit surprising, up here at what looks like about 31 days. The other 3 regions are pretty closely together from about 24 to 26 days for 75% of the sellers to sell their property in the current conditions. Here's the ask price reduction. So this is how much are the sellers reducing their own ask price in order to get the offer. And you can see that the downturn for Silicon Valley, the purple line, started right here at the beginning of the second quarter, and it's been coming down. But when it's a tight metric because the vast majority of the sellers don't reduce their price at all, but that's somewhere around 99.4%. Or in other words, sellers are taking 0.6% reduction on average, but that's 15% of your sellers taking a fairly significant price reduction and 85% not adjusting their price at all. Here's the frequency of the sellers. So coming down to Silicon Valley, it's the least common. It's somewhere right around 12.5% of the sellers reducing their ask price. So that's only 1 out of 8 sellers. The most common regions are the Central Valley and then on North Bay area, and they're sitting up here at about 24% of the sellers. So 1 in 4 of the sellers, so double the rate of Silicon Valley. Here's the overbidding. So this is where we flip over and we look at what the buyers are doing. And this is how much competition the buyers feel. And here, the San Francisco's Marin, the cities region, is right up here with Silicon Valley. but they're way above the other three regions. So you have two regions up here at about 9% overbid. So that's on average. That means some people are paying 18% over and some are paying 0 over, but on average, it's 9% over their asking price. The next closest after those two is the North Bay, and it's down at 2.5%. It's like 1/4 the magnitude of overbidding. And Central Coast is actually very close to 100%. It's about 1/4% over asking price. This is the frequency of overbidding. So Silicon Valley comes away with the most at around 77.5%. Then you have the cities. So then you have North Bay, the Central Valley, and then you have the Central Coast at the least, with just over 44% of the sellers getting more than their asking price. So you go from 44% up to 77% of the sellers getting more than their asking price, depending on what region. Here's the total appreciation. It really shows that the cities, San Francisco and Marin, has done poorly with only 50% appreciation. Silicon Valley is a little bit over 100%. Central Coast is right at 100%. Central Valley is at about 93% appreciation. And then the North Bay is about 75%, 74.5% appreciation. So, 74 to 102%. That's a pretty, 25% range where everybody's in. And then to have the San Francisco and Marin 25% below that is really speaks volumes of how those two areas have been hit, or that one region, those two counties have been hit by the pandemic. It's definitely pandemic related. You come back here 2020, they're all orange is right in there with everybody else. As soon as you get into 2020, orange soon came on the bottom. And then basically with the slowdown in 2022 is where San Francisco and Marin really has not recovered from that point. Where if you look at the bulk of the areas here, you got Silicon Valley, Central Coast, and North Bay, they're down at like 50% appreciation, and now they're at close to 90% appreciation overall. So come up quite a bit, where the San Francisco and Marin is basically at the same level. The worst for them was 2023, right after the 2002 crash. Here's the median sold price of all the regions. You can see that San Francisco and Marin is very similar now to Silicon Valley. Historically, Silicon Valley has been quite a bit lower, or depending on how you want to say it, the cities has been quite a bit higher. You can see the vertical separation getting smaller. For a while there, they were upside down, where the cities was actually lower median price, came back and recovered, and now they're basically been the same almost this entire year, so all of 2024. Central Coast down here, North Bay, and then the Central Valley. So Central Valley is obviously the most affordable at about $575,000 for a median price. Here's the payments. Interest rates have come down a little bit, but in general, the trend is going to be the same as the price. And don't forget to like and subscribe. And with that, I'm open for any questions anybody has. Not seeing any unmuted mics. Thanks for joining and have a great day. Bye for now.